All right, everyone. Starting to get a lot of people joining the webinar. Appreciate everyone joining us on a Monday afternoon lunch hour. We were just chatting right before we got in here. It's the fall feels are starting to really hit here in Chicago. Nice 50 degrees, early brisk walk. While you're popping in, we did drop our LinkedIn's into the beginning of the chat. And also would love to see where everyone is working on, calling in from, add your LinkedIn as well, so everyone could connect with each other. We always like to form community and collaboration. It's a great way to interconnect, ask questions afterwards, and make sure everyone is getting what they need. As we kind of chatted about, this full webinar will be recorded with Eric and Danny. We'll host it on our Substack. We'll send a follow-up email as well to everyone that's registered, so you get access to the full recording and takeaways. So we're just excited for you all to be here. We'll give it another minute or two as people start to come into the chat, and then we will kick it off in probably 60 seconds or so. Also, if you are actively fundraising yourself, kind of hit it with an emoji. We'll get a feel and a sense for what everyone's here for, and then I'll be quiet for a minute. There you go. All right, I think we're in a good spot here. So again, appreciate everyone joining today. It's going to be an incredible chat with Eric Rubin and Danny Goodman. Eric coming from Red Swan Ventures and Danny from P33 here in Chicago. It's such an important discussion, understanding the two parties in the fundraising capacity, both in founders and funders. A lot of times we all speak different languages. We all have different ambitions and intentions and understanding of what's actually there. And most of the time speaking two different languages, working at two different speeds. So it creates a lot of contention in the space. So I think it's really important as we bring these conversations together, how someone like Eric looks at deals, but being both as an operator and a founder and an investor, and Danny and myself in a similar space, able to see both sides. But a lot of times you're not able to do that. And even if you do, you may kind of be, have your blinders on and just focused on your end goal. And it creates a lot of difficulties in that situation. So I'm really excited for this conversation. I'm really going to sit back, listen, learn. As questions come to you, hit the Q&A button, pop your question into there. I'll be moderating and bringing those questions forward. Please do it in there so we could track it. If you find yourself not, hitting into the webinar chat, that's fine. I'll be looking at that as well. But to give you an overview, this is our 8th incredible community chat. Danny Goodman did an amazing job bringing Eric and team together to have this conversation. For us as Bionic, we support the founder community in the growth stage, pre-seed, seed, going to A. A lot of consumer, B2B to C, but our real focus is to help you overcome obstacles, create more connective tissue and continuity in the startup space, because it is so hard. Being a first-time founder, second-time founder, things are challenging. Getting the right access, the right information, the right platform, those are things that we really want to help our founders in our network succeed upon. So we'll continue to have these webinars and community chats. All of them can be seen on our Substack, post-recording and shared, and we'll again share that with everybody. And just the background, I've been in the startup space. My name is Justin Cohen. If I didn't make that clear at the beginning, I apologize. In the startup space for about 20 years, working on companies from the very beginning, employee 1 to employee 10 as a chief marketing and chief growth officer. I've helped 2 of those companies scale and sell over $1.25 billion exit between those 2 organizations in fintech, proptech. Been a founder as well. Been in startups that aren't so great as well. And now I'm really kind of bringing all those learnings and lessons together to help early stage companies become more successful and scale much more efficiently. I'm going to give you a quick background of both Eric and Danny. You may have seen it, obviously, when you signed up in the webinar, and then I'm going to sit back and let these two have a great conversation. So love to welcome Eric Rubin here with us today. He's currently a principal at Red Swan Ventures. Red Swan Ventures is a pre-seed seed fund founded by Andy Dunn and has backed companies such as Coinbase, Scopely, SeatGeek, Hinge, Warby Parker, and many others. Before VC, Eric was an early stage operator of two different venture-backed companies, Tech and Measure and Pi. He started his career at Goldman Sachs before pivoting into the technology startups. Thank you again, Eric, for being here. We're excited to jump in with you. And then Danny is a member of P33's founders team, where he leads initiatives to accelerate the flow of capital in Chicago's tech ecosystem. With a rich background in early stage ventures, he has contributed both as an operator and most recently at Reforge and previously at Section 4 and as part of the venture investment teams. A lifelong Chicagoan with deep industry connections, Danny excels at linking founders with essential resources and networks they need to build durable and successful businesses. He holds an MBA from University of Chicago and a bachelor's from Tufts. So great people here. I'm going to sit back, enjoy the conversation. Danny, if you want to take over from here, let's jump on in.
Yeah, and first things first, yes, please definitely use the Q&A. This is definitely I've always loved the term fireside. I wish there was something more casual, almost even, because this is definitely meant to be a conversation, and you'll hear me use the phrase black box multiple times in this chat. And the whole goal of this is to demystify a lot of the things that a lot of us just feel sort of uncomfortable, like unpacking and poking around. And so hopefully this chat can just sort of like demystify and dress down a lot of things that we just have been wondering about. So without further ado, and maybe perhaps first of all, congrats, Eric. Andy, congrats are due to you, to Andy, and the early team members at Pi on your recent fundraise. And we've chatted about this before, but for everyone who's in attendance here, tell us about how you and Andy met, and what were the early days at Pi like?
Yeah, thanks for having me here. First of all, I'm pretty excited, Danny, when you mentioned, hey, I want to get this sort of fireside on demystifying VC. That's something I think I've been in a pretty unique seat, and I'll explain more. But yeah, let me dig into maybe how I met Andy. It's actually a really fun story, and then we could chat about Pi. I think me and the early Pi team made a lot of mistakes that Andy was able to learn from, and so it's pretty cool to just see things really working right now. But yeah, how I met Andy. So yeah, I'll try to tell the story as quickly as possible. So I was a very early customer of Bonobos. I mean, this is probably 2008. You know, some guy started selling pants on the internet. I found out about it online. I was like a tall kid and it like my pants never fit. And I'm like, let me figure this out. So I order some pants. They fit great. And I wasn't really interested in like business at all. But I was like, what is this company? It was like I was mind blown. Fast forward probably 10 years later, I'm working at Goldman Sachs, uh, pretty lost in terms of what I wanted to do with my life. And I send Andy a cold message, which sounded like a lost 25-year-old. Hey, I would love to work at Bonobos. Never answered. 1 year later, you know, fate brought us together. I was at a coat rack after this conference, and Andy was right there. And I was like, I got to go say hi to him and tell him this whole story. I sent you a cold message. And that was really it. Like it was such like a fun little story. And I told him I wanted to start a company, which was true at the time. And we just started meeting like every Sunday. And there's a little bit more towards the story. I actually grew up playing tennis and he was like learning how to play tennis. And that was a great connector. So that was really how it all happened. And when I was iterating on my own company, he was like, hey, I had this idea for Pi. Do you want to be my first employee? And sort of the rest is history. So that was like 2019. So I've known Andy like 5 years now.
Okay. And so from coat rack to early team member at Pi, and tell me about the early days a little bit there. Like what was sort of being like sub 10 employees at this founder Bonobos startup like? Like what were
Yeah.
those early?
Yeah. So first off, I was at a startup before where I was like an early-ish employee. I think it was like, I don't know exactly, but we actually got acquired by Bloomberg. And I met Andy as that was happening. I think my idea of a startup was a little naive because I came in like post product market fit, We had an exit. I was like, oh, I knew it was hard, but I'm like, oh, startups like go well. There was nothing ever like too crazy at that startup. Um, so when I met Andy, he had a very loose idea of what he wanted to build. This is right before COVID. He had a really good co-founder with him. And yeah, like the initial idea was pretty funny actually. I don't know how much he's talked about this. This is like the OG pie idea. The company is actually called Pumpkin Pie also. So his family member, she's a widow and she was trying to date as an older woman. And he realized like making a dating app profile is incredibly hard. It's like we're used to it as like millennials and Gen Z. It's like, oh, it's easy. If you're an older person, it's actually kind of confusing and you don't know like what to put in there, whatever. So he's like, we're gonna create this like question game where we serve you 10 questions every day that are really interesting. And based on how you answer those, we're gonna like build a profile for you. That was the insight. We're gonna build a profile for you. And that was sort of the original idea. We pivoted very quickly, but I think that we could talk a lot about this and how startups pivot. But like that was actually the original idea that we raised money for pie. It was pumpkin pie at the time. So yeah, I'll stop there and let you ask some questions. But that was yeah, sort of the original. I could go a little deeper into like what that was like, pivoting, having a really good team and all that stuff. But you tell me what's helpful.
Well, that's interesting. I think where I actually want to go from is like, when did you start feeling like, when did you start uncovering the interest in the investment route? How soon into
Yeah,
that journey did that sort of insight in that field become interesting to you? And or
yeah,
was that something that was always interesting to you? Like, tell me more about that.
yeah. So first off, I think I'm like a deeply curious person. And from day one at Pi, like I was kind of obsessive over, like this is a space we're playing in. What is the history of people who have tried these concepts? Who are competitors in the market? Who can I talk to at other companies? And I think like actually I started realizing over time, like really good characteristics of a VC as well. I think just being curious and talking to a lot of people and learning. Um, I loved building, and when Andy hired me, this is a true story. My offer letter said head of unscalable things. Those are things I love to do. Um, so it was pretty interesting. Like I think we had a lot of ups and downs over the 3 years I was there. COVID hit. That's a huge part of this story. We had to work remote. Building a team remote and building a company that's supposed to be a huge, generational company remote is really hard. That's a major change Andy made. That's really flipped the switch on Pi. He moved the company to Chicago. I think they're in office 5 days a week now. I'm not sure. I got to confirm with someone there, but that's like a huge thing. And I think when a startup isn't going as well as you'd like it to in the early days, kind of working from home and just like sitting with yourself there and think about like, wow, this is hard. Like I can't just like turn to my teammate and talk about stuff. Like that was pretty difficult. So it's pretty interesting. I think as the company was like having its ups and downs, I actually got added to the Red Swan Ventures Slack channel. And the reason there was I started just helping look at consumer focused deals, consumer tech focused deals. Um, so, and we could chat more about this, but there was a time in my life where I was in, actively we were raising for Pi. So I'm in the Pi channel and I'm working on a startup, and I'm also in this VC Slack channel, like looking at a deal here or there, seeing how VCs are talking about looking at a deal. That was fascinating to me, and I think for me that was like I don't know how many people have been in that like seat at my age where you're just like live seeing these two things happen. And I think a lot of this is relevant to stuff we'll chat about. And also, yeah, maybe the full switch. So a big catalyst there is like Andy moved to Chicago. Like we weren't in person anymore. He had to move back for family reasons. And I just miss like being with him in person and building that company. And we decided to part ways and make Red Swan a full-time role. So it kind of organically happened actually. And at this very moment in my life, like I absolutely love venture. I think that was a great decision. And Justin, I think as you said, like I love that I kind of went through some of this startup stuff because I get it. There's no other way to put it. Like we had some really, really low lows while those early days at Pi.
Right. And so one thing you mentioned, so this your enduring curiosity. Uh, I think that's something that I've seen is a through line in most, if not all, the investors that I've met and worked with in my life. What other aspects of your operating experience influence the way that you invest now at Red Swan? And are there any other specific insights or lessons from being an operator that you wish other founders, especially the founders on this call, understood?
Yeah. So I'll tell you, I think the thing that was really hard the early days of Pi and how I look through this lens now when looking at investment. So I think I think having been in a startup that worked, um, going to a startup where, like we really struggled in the early days at Pi. Um, there's one thing that really stood out to me. Um, at the beginning, we weren't building Pi for ourselves as a consumer technology product. That was very hard. And the reason that's hard is because you're constantly guessing what your users want. And in consumer tech, people, you go to people, they're like, yeah, I think I'd use this. This is a pain point in my life. And then you put the product in their hands and they don't use it. I think with like B2B, that's a little different. You go, you kind of do a pilot, you're really getting in the weeds on their pain point, you build something for them. So this maybe is a little more true for consumer technology, but I think it's also true for a lot of B2B, and I'll tell you why. But I love when founders are building something for themselves because they understand the nuances of the pain point and the potential solution so much better than anyone else can. I think that was something that was really tough for us at Pi in the early days, and I think that's been a big shift for Andy as well to like move this into a product that he truly wants and wanted to use himself. And I think the results are there right now, which is amazing. And look, the reality is like startups are so hard. I think like some of those low lows, like I think building something for yourself, you have this like delusional passion that this needs to exist in the world, and you're kind of just going to deal with the hard moments because you're like you have so much conviction that this needs to exist. And a lot of that is just getting investors on board with you, and we could chat more how I think you do that. But I think that was a huge lesson for me. Like you really have to have conviction, potentially be building for yourself. I think those are little hacks. Like I think that was something that was missing when I was at Pi. Like I wasn't helping build something that I would use. So it was a little confusing on which direction we should go sometimes.
Got it. Well, and we're
And
definitely going to come back to this the idea of conviction and building conviction for yourself as well as for your investors along that conversation process. But anything else that you think that founders tend to either overthink or potentially underthink as it relates to um, working with investors or the investment process?
I think like look, people have asked me this all the time. Like I'm here, like I love startups. Like I've talked to other venture people. They're like, you love like seems like you love building. Would you ever go start a company? And my answer is like, I have no idea. Like maybe. And the reason I say that is just because like I will only start a company if I have like crazy conviction on what I'm doing. And the reason I think you need to have an incredible conviction is because investors or good investors are going to be able to like see that if you don't. And I think it's very easy to like sell and pitch if you do have that conviction. So I think there's ways to get that. Look, I have some friends who are really good founders right now, and I'm like in their Slack channels with them because I really want to like be with them, and that's how I stay sharp and learn. Um, a lot of my founder friends like really validated what they were doing for a bit before jumping in to get conviction on their own first. I think something I see is like a mistake sometimes, and it's tricky, right? You quit your job, you want to go start your company. I think you really want to be like ready to go and make sure you did the work to validate that, hey, this is directionally a really good idea. So I'll kind of stop there. I think that's a mistake I see a lot of people make where they're like, I'm going to go fundraise. And, in this seat, you see a lot. And I'm kind of like, okay, like I've seen these companies. I know they haven't worked. And then I ask that question, like, what do you think about these? And they haven't done the work yet. And these are little signals that precede that I have to look for because there's not a lot of data points. So, yeah, that's a quick tidbit on that.
Cool.
Yeah, I had a couple items that I could jump in with that I thought was fascinating to kind of put a pin in. One you just said, which is um, someone's always built something that a company has been starting or looking at. Very rarely are there bullshit ideas. You may be iterating it a little bit differently and deploying it to the market a little bit differently, but understanding what's there is really important because VCs see hundreds and thousands of deals and opportunities as things flow through, and it's very rare that you haven't seen something in that category. So very important to not say we're the only one or only one doing it like this. I mean, obviously you want a differentiation, but understand why that differentiation positions you in a way to succeed long term. It can't be a small change. It has to be a standard deviation or two away from what's there. The second thing I heard, which I really want to hammer home because it's very near and dear to me too. It's founder market fit. Um, really diving into something that you want to change and something that's impacted you in a way that you see there's a large opportunity behind it is very important. You have to have the passion. If you're going to go through these ups and downs, which you're going to experience, you have to have the wherewithal to get through those items. You're going to hit the despair, right? It's just impossible. The trough of despair is going to happen. Right after you have a high, you're going to hit the low, and it's like, how do you move through it? And moving through it is I'm solving something that really is important to me, and the reason why it's important to me is X, Y, and Z. So really, really make sure you do that. It can't just be chasing money. Don't chase fame. Don't chase status. It's never going to work out for you. You're gonna fail that way, and you should be looking at it from how do I make impact and change. The third thing, it's more of a question, Eric, that I really loved that you said earlier, which there's this overlap that you're able to see in real time of your founder chat, from Pi and your investing chat from Red Swan. Like what we're talking about, decoding and mystifying, like what are things that you kind of maybe took away from what was happening on either side that creates this overlap, this kind of Pareto, the in between, that could be an interesting spot for founders to think about as they're raising capital.
Definitely. Yeah. To be clear, I'm not in the pie chat anymore. I'm fully Red Swan, but there was a time in my life. Yeah. There's a time in my life when we were kind of doing both. And this is a really funny thing. And I'm still like learning as I go. Right. I think when you're at a startup and building and you're clearly there because you have conviction, you're looking at all the ways this works. Like you're kind of like blinders are on sometimes. You're like, of course, this makes so much sense. You're like you're such an optimist. I think to be a good investor, you have to be an optimist, but to be a disciplined investor, you also have to look at the ways like, how does this just go like really bad? And the way we do things at Red Swan is, we look at these risks in every deal at pre-seed seed. There's hundreds of risks, but you want to take the main ones and then work backwards. Like, how could we de-risk this where, venture in itself is an extremely risky asset class, but like, how can we de-risk these things? So yeah, it was interesting when I was in both at the same time. You kind of have this like, on the one hand, you're really looking at all these things that cannot work very critically. I think when you're building, you're in this like crazy energy of optimism where you're like just want this to work so badly, where sometimes like you actually forget about like all the flaws. And this is my style. Like I don't like, I'm hoping to carve my own style out in DC. Like I love when I talk to a founder because it helps me. I'm just like, what are like the things that you're most worried about? Like tell me right now so I can like kind of just figure out with you, like, how does this potentially go really right and how does it go potentially really wrong? And once I know that, it's actually easier to get conviction, believe it or not. Instead of like, because everyone knows who's like been in a startup or invest in a startup, like most of them don't work out, right? So like that I think that's like a very interesting thing that I learned from like when I was in both these Slack channels. Like there is this like mismatch in how you're thinking about things. So I think more transparency on both sides just helps you build conviction actually as an investor.
I think that's
Is there
100% right. I
yeah.
think it's like you're trained to say yes as a founder and trained to say no as a VC, because VCs have limited capital they can deploy
Yep.
and limited opportunities that they could invest in. So it has to be trained at that. We're starting with a no. We got to get you to a yes. And it's the
Yep.
opposite side on the other end, right? Founders started yes and maybe never get themselves to a no on feature sets and
Yep.
deployments and stuff. So it's fascinating to kind of, when you're building things and when you're building your pitch deck, like I've seen certain pitch deck experts talk about, include a slide of like why not to invest in us, because it's a way to show like we've gone through some of this exercise, and it helps the VC kind of clearly see those items too. So it's interesting to kind of flip it around. And I'll be quiet now. Thanks.
Oh, no. I think that's a good point. And like, let's come back to conviction in a little bit. I just want to, for time, let's go into some VC incentives and structure chat.
Yep.
Okay. So I don't think a lot of us even talk about like what VC firms, oh, I'm in a room with, responsive lights, what VC firms look like. So let's start there. So what's the structure of a typical venture fund? And like, can we talk a little bit about like the rhythm of a venture fund? Like, what is this Monday meeting that a lot of founders have like maybe heard of, but like maybe never even like thought too much about?
Yeah, definitely. Yeah, I mean, look, like in the spectrum of venture funds, and I assume most people here early stage, right, is like pre-seed, seedish. Yeah. So I'll more focus on that. Look, I think you have for the most part, these funds are just smaller. I think we're seeing like the larger mega funds starting to dip into like seed a little bit more now. But I think more or less like when you're going after that initial capital, like these firms are smaller. They're very lean teams. I could talk, for me, Red Swan, it's we're very lean. It's me and my GP full time. Andy's a partner. He's obviously working on Pi full time. And we have a venture partner. So like we're 30, I think it's 32 million in assets in this current fund. So I guess maybe the rhythm of the fund, and I imagine most of them work this way. I think a lot of these smaller funds are solo GP to begin with, actually. That's probably by design. I think some GPs just want to, make their own decision. They don't want to get bogged down by having to pitch a committee and all these things. How we do things at Red Swan is pretty autonomous. Like my GP, Sandy, he's been doing this a long time. He kind of has his own deals in the pipeline, taking calls. I'm doing my own thing. We meet every Tuesday instead of Monday. And that's like our partner meeting. And the way we do things is, hey, these are some companies I'm chatting with, and here's some that I've done work, and I'm pitching you. And this is my thesis on it. This is why I like it. Should we drop not everything, but most of what we're working on, and just like really diligence this deal right now and try to get conviction? So I think like for us, the rhythm is this. I've worked in BD before, right? This to me feels closest to biz dev, where I'm always trying to manage my pipeline. Like I don't want to have too much at once, because what happens, and I am definitely guilty of this and I'm getting better. I take too many meetings at once, actually, and I take too many calls in 1 week. Hey, there's like 3 really good companies in here. We do a lot of work and a lot of diligence, and sometimes I just can't move fast enough because that's our style. And that's something like I constantly am trying to get better at. I think what I'm doing now is really trying to have a pipeline that I can manage and make sure if I'm ready to pitch that I can get conviction on. And I think most funds are like that, to be honest. Like I don't think a fund should be spending more than a month like diligencing your company. And we could chat more about like how do you get to know a VC and all that stuff. But I think from the day like I'm raising right now, I think if a VC is spending more than a month asking for crazy things and whatever, to me that's a bit of a red flag. And that's a stylistic choice. That's not how we do things. And maybe that's because we're more of like ex-operator, ex-founder VC. But I usually think for a pre-seed, the diligence process should be like a month, and that's plenty of time.
Okay, so I'm gonna want to double click into the diligence process for a second, but
Yeah.
before we talked a bit about like compensation structures. So actually, I'd like to start there before due diligence. Um, we talk a bit about how you guys are actually compensated and how that actually affects decision making. So how do you all get paid? What does that look like?
Yep.
And what are these limited partners that we all have talked about before? Who are they?
Yeah, totally. Yeah. So it's kind of funny, right? Like I think there's a moment where we're in the seat and founders are constantly pitching us. But there's like this whole other world where you actually have to go raise money, which is actually as a VC fund. And I was actually reading something today where someone was like saying it's actually might be harder to raise money for a fund than it is as a founder. So there is like a funny dynamic sometimes. And yeah, look, this money like can come from high net worth individuals who, yeah, maybe they started a huge business and they're just like, okay, I love startups. I want to give you guys some money. Family offices. And as you get bigger, I'd say like north of maybe like 35, 40 million in assets, you start to talk to maybe endowments and pension funds. So all those, those are more or less the LPs. The way these things are structured, VCs get paid, like our salaries come from what's called a management fee. This can go, it depends. Like maybe let's call standard is 2%. We get paid 2% per year on our total AUM. As you add more partners, maybe this is a misconception. Like we don't really get like in general, and the more partners you have, like the more you're splitting that up. So a lot of like, I've always said this, like VC is not a great way to make money quickly. It's a good way to make a lot of money potentially if you're really good at it in a really long time, because like the fund cycle is 10 years. So I'm 30. If we're really good at our job, like I'll see this money in 10 years. Like that's where like a VC makes a lot of money. For a smaller fund though, like I think there's probably founders paying themselves better, honestly, salary wise in a lot of cases.
And so, okay, so taking a step back then, you have this fundraising dynamic where you are responsible for returning capital to LPs. That's essentially your business model. Where does that sort of set you up in your relationship with founders where it might get you into some interesting waters with founders, where it might influence the way that you might interact with founders, where it may create some alignment issues?
It's in terms of what? Sorry, I'm not fully
Yeah, so like
understanding
in
the
terms of
question.
like let's talk about like exit recommendations or
I see. Oh,
recommendations.
yeah. Okay, this is actually a great question. So I think before, I grew up in New York, small surf town on Long Island. Like I didn't know anything about tech and VC. And even when I was at Goldman, like I didn't know anything about VC and tech and incentives. I think that a huge disconnect I see, and I probably sent this, one of my more common past reasons is like, I think this is a really, really good business. I actually believe you're going to make a lot of money from building this. I don't believe this is a venture business. And I think this is one of the maybe like should be like really well understood if you're starting a company. So a VC fund by nature is a power law game. So, we're going to invest in 35 companies. The way you get great returns, and that's, I'd say 3 to 5xing, the money raised over 10 years, those are actually going to come from like a couple of companies that get huge. And these are, I was not here when we invest in these companies, but Coinbase, Scopely, like these were like $1 billion company. I mean, Coinbase is like an unbelievable exit, but a lot of the returns come from a few companies, right? So as a venture investor, you're really focused on looking for companies that you think can get huge. And believe it or not, sometimes these companies are harder to wrap your head around at first. They're a little bit less obvious. The business model you might like scratch your head. It might look a little bit different. Because this isn't like traditional private equity where it's very predictable. And the other thing I'll say is like, yeah, like there is a world actually where you sell your business for $100 million. That's like incredible as a founder. That is so cool. It's awesome. But if the venture investor got in at like a certain price, after a pre-seed, that's actually not a great outcome for the venture investor if they're really trying to have top quartile returns. And I think that's a really important thing to understand when pitching a VC is like, this is the wedge, this is how we get going, but like, this is, if things go really well, this is how it becomes like just a huge company. And I think there has to be like a big vision there. And I have to feel like the founder believes that themselves as well.
Do you feel like I have this struggle sometimes when communicating with founders, sometimes where it's like whether it's explaining what venture backable means, or explaining why another firm may have passed, or like, what do you see as like the guidance, I guess, for founders, like when like I'm trying to think like the best way to phrase this, even like maybe we'll skip it and come back to it. I'm gonna think about how
Okay.
to word this one because it's on recording.
And I think also another question you had is just like alignment, right? Like, look, I'm carving my own path on how to do this. I think at the end of the day, like this job at its core is it's a client service job for founders. Like none of this is possible without incredible founders. I think for a VC, reputationally, to tell for someone to have a really good exit opportunity, like where you're making life-changing money, right? Let's say you raise a little money, you have a $50 million acquisition offer. Like what I would do, that's not a great outcome for me as a venture investor, but I'd more likely tell the founder, like, what do you want to do? What's about best outcome here? Because like, if you don't actually want to go and try to build a huge company, I would say take the exit, like, because, or else we're just going to like drag this along and maybe it's like, take the exit and let's start something new together, like whatever it is. So, um, I hear that a lot, right? Like that's a thing where maybe a bigger fund, like it makes sense to encourage the founder to like keep going, but I think that has to be coming from the founder. And that's okay, in my opinion. Like this is being a founder is so hard. So to like tell someone like, no, you have to go bigger, you have to keep going. If they're not in it after 4 years, like it just is what it is. I think you have to do what's best for the founder.
So, okay, so I guess maybe that's a good point then to talk about dilution. I feel like that's something that comes up with a lot of the founders that I work with at P33.
Mhm.
So, okay, basic building blocks first. How does dilution work? And then why is it important for founders to understand the implications of future funding rounds on their ownership?
Yeah, I mean, I could give a live example of something that
Do
recently
that.
happened with us. So there's guidance for how much of your company you want to give up to get going, right? So I don't know, it's like really simple example, raise $1 million at a $10 million post money. You've decided you want to give up 10% of your company, right? That just is what it is. Um, there's a spectrum of that initial capital and how much you are willing to give up. I think what you have to keep in mind as a founder, like to build a huge company, you have to understand like you're going to most likely continue to raise money that's going to continue to dilute you over the period of your company. You don't want to actually raise a ton of money because you're just going to get so diluted by the time you're at like a series B or a series C. Where like, is this even worth it for me as a founder anymore? I think this is something like learning from Andy and my partner. Like we're so founder friendly. Like we if we feel like you're diluted too much already because like maybe you took money from an initial investor and we're like, those terms like weren't good. Like we're sorry, but like you shouldn't have taken that money because you're so diluted. We want our founders to be incentivized. Like we want you to own most of the company. So that's like a very tricky game to play. Look, there's other things I could talk about where, you don't want to, when the market is really hot in 2021, there's a lot of founders raising at really high valuations. They didn't want to give up much of their company. And all that happened, and I'm seeing it now, is you have to be able to grow into the valuations as well, or you're going to end up in a situation where you have to raise a big down round or a flat round. And these are things that really, really dilute you, especially think about your employees as well. Like all of a sudden their equity gets cut in half, and it crushes morale. So there's a game to play there where you want to make sure you can grow into these valuations. I at Red Swan, honestly, I've seen companies I thought were like killing it, like raise big Series B, whatever. And we get sent their information and we're like, wow, like they were not where they needed to be. And now, yeah, unfortunately, like they're in a really brutal situation because this is maybe would have been a good company, but they took money from the wrong person who pumped up their valuation too much. And it was just unrealistic to grow into that. And I'm seeing that a lot. We can't do those deals, but there's a lot of, it's called like a recap where you kind of just start fresh more or less.
Something you said around decomposing risks related to founder milestones is really sticking in my head. What guidance do you provide around the amount that founders should be raising? How
Yeah.
do you, what's sort of your recommendation there?
Yeah. Look, when we're underwriting a deal, like I think if we do a pre-seed, we want to make sure the capital we're giving this person is enough capital to get them to that next milestone. Where then the seed investor, or if we invest in seed, the Series A investor is going to be like, wow, like they're at a great place right now. They did exactly kind of what they said they were going to do with that capital. And that like that's what we're looking for. Because what we
Right.
don't want to happen, yeah, we don't want to give 250K, and we actually write larger check sizes than that, but we don't want to put in 250K and it doesn't give you enough time to actually prove this out. That's like the worst because we're like, okay, this is like starting to go, but we didn't give them enough to get them to where they need to be for that next investor. So it's a calculation on both sides. Like I like to be really open about that. It's just sort of like, how much do you really think you need to take? My honest opinion is like, as a VC, like a lot of times the answer is like, you shouldn't take that much actually. And just be really scrappy and lean about it. Don't unnecessarily dilute yourself. Yeah, so I think that's how we look at it, to be really black and white. It's just like, how much runway does this buy you to get to that next round and to execute what you need to show to get, a Series A investor really excited.
Got it. That's interesting. And then just before we dive into the founder-funder relationship, I saw that we had a question from Kapil. How would you distinguish a pre-seed from a seed company for consumer?
It's a great question. It's actually candidly something I struggle with, and I'll tell you why. So, having built a consumer tech company when we were at Pi, the reality is, in my opinion, and I don't think a lot of VC people agree with this actually, I don't think you're going to see like meaningful metrics until you're at like that Series A level. Um, if I had to choose the best time to invest in a consumer tech company, it's probably Series A, because you're going to have like hundreds of thousands of users. I can kind of see like your virality coefficient. I can see your retention out like 180 days. Like I actually can mathematically make a bet on this that it's going to have a really good shot at working. At pre-seed seed, like consumer tech is way more than B2B. It's so experimental when you're building your initial products, because like you're more or less sending it to like more of a mass audience. So it's a little bit of like, hey, I think this is what we want to build. We're gonna like dog food it to get it out there. Shows like a little bit of traction. It's the lines are very blurred for me a little bit in consumer tech for like pre-seed seed. I think ultimately when we get comfortable with like a pre-seed or a seed consumer tech bet, it's because like we really get conviction that like, hey, this is like a very unique idea. They're playing in a very unique market. It looks completely different than anything we've really seen before. And or like we really think this team like knows how to build consumer tech products. And also I just want to say like the line of like pre-seed and seed is really blurring now. For me, what I'm seeing at pre-seed is it's turning a little bit into these like $750K to $2 million initial rounds of capital to kind of get you going. We usually like to see a little bit of proof of concept just to show that like, you kind of have something working here. Sometimes it's fine. We'll just do a founder bet, but that's tricky. But we'll do it. And then I think seed rounds for me, At least in like New York right now. I think Chicago may be a little different, but those tend to just be a like larger amount of capital raised. Maybe like 3 to 4 million um for the seed rounds.
Okay. Actually, there was a question that we were talking about earlier, and I'm scrolling through my notes. You mentioned New York versus Chicago there. And so before we go into the founder-funder relationship and comm stuff, could you talk about the different styles between geographies and how context can inform just these different investing styles and just why that might be important
Totally.
on this call to know?
Yeah, I think yeah, and it is a probably an opportunity to be like really transparent what I've seen, and
Yeah.
because we have Andy boots on the ground, he's working on Pi really full time, but he'll send us founders in Chicago. Like, we operate a lot on the coast too, right? Like SF is sort of like the mecca for tech. New York's become really strong, and actually also think Chicago is becoming really strong, which is great. The difference, what I see as an investor, is like we'll go talk to like a founder in San Francisco, and the initial valuation starting points are just like sometimes crazy, like really high. And there's actually appetite out there because I think there's so many venture funds in like SF where people they just get the money, like more or less. They'll get the money if there's like, in my opinion, a little bit crazy valuations. I think New York and Chicago is a little bit like more aligned on like VC and founder and getting in at like an appropriate price. I usually like just feel more aligned with the founder, usually in like Chicago, New York. I think, yeah, I think just for it's like some of these rounds in San Francisco like move so fast. And I talked to the founder, they're like, let me know by Friday. And I'm kind of like, I'm just like, that's just like not how we do business. We're not going to drag you along for 2 months, but we also, need a couple of, like, we need a month to at least dig into this and get to know you. So it's more of like a valuation thing, if anything, to be honest. I can't speak to the style of like firms. Like, I don't, yeah, I know mostly New York firms, but I can't really comment on like what VC firms do. I'm just commenting on like what the expectation is from the founder in these different geographies sometimes.
Right. Okay. Well, there's a lot we could
And
dig in.
well, I'll tell you what, I do have one reason why maybe the valuation is justified. I will never argue with anyone who's super pro San Francisco. They do have the most dense talent network in the world, right? So if you're starting a company, the reality is like you're probably going to find a great engineer like very fast because you're just surrounded by them and the networks are really strong. I think New York and Chicago, they're all there. There's great founders. It's not quite as dense as like a San Francisco. I'm not saying that's a good reason to their valuation, but I think these are ways people sort of like reason with it. And to be clear, like I'm excited. Look, we focus so much on New York. I'm betting my career on New York. I love to do most of my deals here. Like maybe that's becoming less true from what I'm seeing. I'm seeing really good teams get built quickly. So, but I'm just giving a reason. I don't know if it's true or not.
No, I hear you, and I'm based here in Chicago, so it's
Yeah.
sort of a similar boat. Um, Pivoting quickly before we hopefully have some time for Q&A. Okay, so something that I feel like every week I'm talking with founders about is the oft-repeated quote, build relationships with investors before you're ready to raise. This feels a little confusing. Where do you fall on this, both first as an operator and now as an investor? And if you think that's valuable advice, how do you recommend founders sort of thread that needle?
Yeah. This is like a bit of a dark art, I think, and
Yeah.
I can't tell you exactly how to do it. I'll tell you what, you know, I'm always trying to be introspective and being like, okay, like why did I really start to get conviction on maybe this founder? Why did we start to do the deal? I think being a pre-seed investor, um, the easiest way I built a totally okay, maybe like let me take a step back. The hardest identity switch I've had from working at a company and being more as like an authentic, like in this founder world as a builder versus being a VC is just like everything feels more transactional now. And I've had to just live with that reality, right? I used to, when I was working on Pi, I could go meet like anyone thinking about starting a company or anyone like at a startup who's maybe raising, these conversations are actually like, I can't do anything. I can't invest in the person. I'm generally just trying to get to know them and learn. I think as a VC, like the reality is like you always sort of are like looking for signals, even if it's incredibly early in their process. So that, I mean, a couple of stories, like, I mean, I've met people who are, this happens now. They're currently operators. And I actually think these are the best deals sometimes. They're currently operators. More or less, they have told me like, hey, I think I want to start something. I'm not sure. And they kind of come to me as like, how would you approach this? And then maybe I tell them like, hey, this is how I think about it. 2 months later, they're like, I have an idea. Like, what do you think? And I'll say like, I'm never going to tell a founder it's a bad idea, especially at that stage. And I'll just be like, look, like, I'll go make you like 3 intros if I know people in this space are trying to sell it or whatever it is. To me, pre-seed diligence sometimes, actually for me, when I get a ton of conviction, it's because I've been like with them on their journey for 6 months already. And those are the easiest deals for me to do because I have so many data points already that this person's executed. They've like told me what they've learned, whatever it is. And look, sometimes I don't want to be like, I can do this for everyone, but it's just interesting. They just like keep me posted. And all of a sudden it's like, hey, we actually have like 100K ARR and we're raising around. And I'm like, great. Like I don't have to guess. I know exactly like, and you've built conviction with me as well. Cause I'm following like these mini pivots as you like ideate. That's like not that easy to do. And I totally understand like there is a point too where you decide you want to start a company and it's like, it's just time to fundraise. I think in that case scenario, I think Justin, you maybe mentioned this, like you really have to find VCs that are, you think, going to be aligned with what you were doing. Because you kind of missed the boat to build that really organic relationship. And this is where it's funny for me, right? Like I'll meet someone and it's like, okay, and then like a week later, they're like, by the way, I'm fundraising. And I'm like, it's hard. Like, I don't really know you. And then I'm going to be like looking at the idea and I'm just like, it's like kind of tricky. I don't have that many data points. So in that case scenario, like, then it's interesting if someone knows what we're really interested in already. And then I'm like, oh, cool. Like, we've been looking at this stuff. This isn't like an idea out of left field that we don't know anything about. Like, like we don't, if someone reached out cold, it's like a deep tech idea. I'm like, I have no idea. Like, I don't really know this space at all. If you reach out and you're like, hey, we invest in a lot of like SaaS plus marketplace businesses. If you reach out and you're building one of those or like a vertical SaaS business, I'm like, okay, cool. Like this is a space we're actively looking at. And to the extent you can figure that out with a venture fund, I think that's really important. And the last thing I'll say here, I think it's important is there are finance only VC funds. Like that's just the reality. They've never built anything in their life. They look at this very much as like you're kind of an asset in a portfolio. And then there's nothing wrong with that necessarily. But like we have other funds like Red Swan, like the way Andy's like injected the DNA of like what he believes venture is for. He is like the ultimate founder. Those funds are going to be very different personalities and they might be willing to take more of a swing on you just because you show characteristics as a person that they just absolutely love. And you have to like figure out the type of venture fund you're talking to. And I hear a lot of my founder friends like, oh, this fund, like they did 6 calls with me and like, they asked for all this like data room and all this crazy stuff. And then they passed. And I'm like, I'm kind of like, hey, it's a little bit on you because you should have kind of like going in, realized like who you were about to work with. And that's just the reality. Like, I think you really got to like do your research and figure out who the right funds are. There's a lot of funds out there. There's so many.
Well, it's interesting. The idea of qualifying your investors is not something that people talk about with founders that much, of like actually talking to other portfolio founders of these investors. It's not something that a lot of founders do or are told to do. And people, it's just not part of the practice. But I think it's, just like the investors are getting into a 10-year marriage with the founders, it's the exact same way. So if I were a founder, I would want to do that homework just as much. If not more.
I had a deal. Sorry to cut you off. It's probably relevant for this, like where, I got kind of interested. I really just didn't understand the space. And what happened was like, founder kept following up. I kept saying like, hey, I need more time to understand. And then I actually concluded myself, I'm like, I'm not a good fit for them at all, because like I don't really understand this space that well. It's taken me forever to like learn it. This just isn't a good use of time for both of us. And I actually just said that. I was like, I'm sorry. I probably shouldn't have like taken a first call. And yeah, I'm learning as I go as well. And that was interesting for me because I'm like, hey, actually, I don't know this space. There's way too much work involved. I'm not actually going to ever get conviction because there's like, I have to take a course in this to really understand.
Right.
So there's a level of as a founder, like be confident as well. Like you're like the VC is there to serve you in a lot of ways. Sure, they have the capital, but make sure like they're really the right partner. Because I haven't been in a situation because we're at Red Swan, just like the history of just like Andy's such a founder. Like this is all I know, but I've heard stories from founders, and you really just have to be careful about like who you work with. The number one thing at pre-seed too is for the founders is someone you trust also. Because most VCs are going to be pretty connected with other investors, and ultimately it's like trust and fit.
I feel like
Yeah.
we could have a
And
whole
even like,
call about that. But yeah,
yeah,
Justin.
I was gonna say even like a couple items like even the smallest investor could create a massive amount of problems for you. I've seen it. I helped acquire a business at one point, a tech business, and the smallest investor, could rabble rouse all the other investors to stay away from the deal. And all it takes is a little bit of push, and unless you have drag along clauses, other things to chat about from a legal side, it could torpedo your deal. So even there is no quote unquote dead money when you're taking on capital from someone and an individual. So be very careful on who you take capital from. Don't just be panicked and just grab money and take it. Make sure you have diligence there on both sides. I really like that approach that both Danny and Eric talked about. The second thing I'll say before we kind of wrap too is I can't tell you how much value comes out of simple outreaches to say, hey, this is what I'm working on. I would love your feedback on it. I'm not asking for capital at this point, right? Creating that relationship and then adding Eric or Danny or myself or whoever you're chatting with to like your monthly updates. And I could see your progression and what occurs. And those little updates, they don't have to be novels and they shouldn't be. They should be really simple, like wins, losses, updates, what's up next, right? And I could track what performance you've done month over month. Are you hitting your targets? Are you hitting your metrics? Are you moving forward? What's going on? And then I get more conviction because I see that you have your thought process behind what you're sending out, what you're working on, what you're achieving. All those things are really good indicators. Some of the best deals that I've been able to find, I've made like 16 different investments. Some of them are from family, friends, etc., that have come over to me. Other ones have come out of Techstars where I mentor at. I mentor at 4 different Techstars groups. I meet those groups at the very beginning of their incubation, right, or their acceleration and their cohort, and I see them at the very end. And you see the traction that's been made, and it's very easy to make a decision at that point and have those conversations. So it really does come down to what do you say is what do you do, and then how are you getting that done. So don't be afraid to add potential investors, etc., to your update list. It doesn't have to be the same way you send to your investors. Note everyone will forward everything, so you don't want to put anything like too confidential in there. But yeah, so that's a couple pieces there.
Yeah, I love that. And just to add on there, like, yeah, there's been a couple of investments where well, that I'm currently interested in actually came out of that, like where we passed, but actually love the founder. I'm like, I think this person's great. I was like, I just don't have conviction on the idea. But a lot of times you pivot around, that's the reality. And there was one the other day where the founder is like, hey, similar market, we're pivoting it. All of a sudden I'm like, oh wow, actually like I'm actually like a consumer for this potentially. And I just reached out. I'm like, can you add me to the beta test? And to me,
Yeah.
it was like a pass, but in reality, I'm just like, no, I really like the founder. And look, I think people react however they want to a pass. I think generally, like, hopefully there's
Yeah.
respect on both sides and everyone's just trying to like run their own business how they need to. But I've seen that work a lot. And yeah, there's people who are like, well, like, don't add random VCs like to your thing. They might tell someone about your idea. I personally, that's ridiculous. Like, there's
Yeah.
no original. You mentioned it. There's no completely original idea. It's all execution.
Absolutely.
So I lean towards like give trust to like I don't think anyone's going to steal your pre-seed idea. There's someone
No.
else probably working on it.
I whenever I see like building in stealth, I chuckle because like unless you're building a pharmaceutical product which has billions of dollars of IP behind it, or you're working for NASA or something of that with governmental secrets, everyone, it's there's no reason not to have it. I know it creates some buzz and mentality, but at the same time, feel free to share and share it more. Even for me, I have similar to Eric mentioned, like I had a deal that came through to me, which was in a space I know of, but I've never really engaged in, like Dungeons and Dragons stuff, right? It's not something I ever played, but the founder, had incredible outreach and follow up. And even when I said I was still on the fence, I liked what he was doing. He was able to send me diligence from other VCs that both passed and invested. And I was like, that's really cool. I could actually see other people's thought process, and I could see what people were thinking about. He's willing to share. And he didn't like, he was kind of like, hey, here's what it is. And I love that. And actually, it pushed me into investing, and I'm glad I did. So be open, with follow up and information that's uniquely different than what you're putting out there to the market that you're sharing as well. So, Dan, you wanna wrap us up here? I know we're 2 minutes over time, but appreciate everyone hanging out with us here.
Thank you all for taking the time. The last thing I'll say is my advice is always try, if you can, to get a warm intro that can help you set good context. The thing that I always like to do when I'm making a warm intro is say, hey, this person can always be a great sounding board for you, because that just helps slide them in as someone who can give good guidance that makes the relationship seem, or takes the pressure off the conversation. I found that to be a successful strategy. And please reach out to me, and I'm sure Eric and of course Justin are here to do that as well, and just to be sounding boards for you all now and in the future. And again, thank you all for taking the time to join us today, and for anyone on the recording, this offer extends to you as well. And hopefully we'll all talk soon.
Thanks, everyone. Have a great day.
Let's go.
Thanks.